Can you hear me? Or good afternoon or good evening? Greetings. Excellent. Thank you. Uh, just answering a question there from Anise. He's asking if I have a website or anything going. The answer is no, guys. Just trading for myself pretty much, doing a little consultancy work. But nothing to advertise, no. Right, so the title of today's webinar is, it's just that we're going to do a little discussion format today, so this is a perfect time to ask questions at any time. Just throw them out there, indiscriminately is fine. We're going to try and take some stock of where we are in the stock market, pun intended, and we're going to talk about the dollar in general and try to think about where we're going on this, where we've come from, and how we can trade it moving forward. You guys know that I'm a little bit dollar bearish at the moment. So we'll talk about these things, okay? And fire away with any questions as you see fit, because this is a discussion sort of format today. I'm not really teaching you anything specific. Yeah. I don't think the euro is going to 80. I want to talk about just sort of general things, and then we'll talk about the specifics of things. And honestly, I mean, could euro be going to 80 cents? Sure. Is it likely? I do not believe so, no. I think that there's overdone pessimism on the euro in general. I think that I think I'm looking at this euro a little bit like when we had the big crash of 2008 and Citibank was at $1 and ARG was penny stock. These are big institutions that probably aren't going anywhere. And I think we're going to look back in 2 years' time on these price levels and think, wow, euro was trading at a 40% discount. You know, is it going to go back to 140 in a blink of an eye? No. I think that that's unrealistic, given the relative fundamentals and technicals for that matter. All right, and I think it's always important to remember and remind oneself that currencies are traded relative to each other, isn't it? And they're not traded by themselves, and that's an important concept. Although it's something we all know, it's something to absolutely remember in everything that you're doing. You know, so I guess what I'm saying is 80 cents would be a little more. 80 cents would effectively be half price relative to the dollar. Has the euro really tanked half of its value relative to the dollar, or potentially? I doubt it, because I don't think that the US is exactly firing on all 23 cylinders. Do I see cable getting to test 4650 or 4680? Could you take a look at it? Absolutely, we'll have a look at that. And the answer to your question is yes. But I'll have a look at it, Jen, and we'll confirm that in a minute. No problem. All right, so let's take a little bit of state of the world address here for 2 minutes. We're in a tough spot. Remember our little sort of checkbox here of how things work fundamentally. Remember, the currency moves in anticipation of interest rates. Okay? They don't necessarily move on interest rates. They move in anticipation of interest rates. Okay, and nowadays we have anticipation of QE and interest rates. All right, so we'll do an interest rate column, and we will do a QE column. And we'll do the US. We'll do the pound. We'll do the euro. We'll do the Aussie, and we'll do the yen. Okay. Aussie has been dropping over the last 48 hours because people are expecting a rate cut tomorrow or next week. So anticipation here is these guys are cutting interest rates. And you've got to remember, guys, is that still we'll take a peek at the euro too, absolutely. I'm gonna try to cover it all here. All right. The world still works like this. I know we're in a global economy, but in the 8 years that I've been doing this, I've noticed this cycle still absolutely in play. Goes like this. Asia. Okay. It's that little recycling thing, that graphic you've seen. So in the US, we go through our little bubbles. The bubble bursts. We slash interest rates. We cry. We jump up and down. The Fed comes in and supports the economy unceremoniously. The economy steadies out. They start jumping up and down about raising interest rates, and et cetera, et cetera. Well, what happens in the US generally will happen sort of 6 months later in the UK, which will happen 3 to 5 months later in Europe, which will happen sort of 3 to 5 months later in Asia. And so this little cycle, yes, there's going to be sort of murmurings in between, but this cycle is absolutely still in play. In other words, what happens in the US then will happen in the UK, Europe, then will happen in Asia. So, well, Australia would be part of Asia in this example. So, my point being is that as currency traders, it's our job fundamentally to figure out which part of the cycle we're in, hypothetically. All right, because if we can do that, you now have basically determined the prevailing trend for the next 18 months. You know, because even though the UK might be lagging the US by 6 months, this, you know, if you're buying dollars, in other words, pound dollar down, you know, it might go down initially and then kind of just trickle after that as it washes itself out of the market, because these trends take months and months and months. Fundamental trends, guys, are one of those things that I struggle myself with, just the time horizon of these things. We're talking about months, big wheels. Big wheels. They don't turn very quickly. Although we might get you know, flashes of changing opinion, the actual reality of it takes a very long time to materialize. And we've seen that in the anticipation of U.S. interest rate hikes. We've been talking about U.S. rate hikes since like last year's summer. Or winter if you're in the southern hemisphere. I mean, like a year now, they've been, oh, things are, you know, we'll have to raise rates. Not happening. Zero wage inflation, not happening. It might take them up a token gesture, but in reality, it hasn't. So I guess what I'm saying is the QE cycle's finished, but that interest rate cycle is yet to begin. And it's going to be very, very slow. Anyway, moving forward. So where are we here? Interest rates in the US. The anticipation is a little bump up. The reality of it is that it's fairly flat. So we'll put flat to moderately up. QE, done. So we'll put an X here. Pound. Interest rates not going anywhere. QE in play. Not really tapering, but not, you know, there's no noise of them adding necessarily. Okay. Interest rates here in Europe at the lows. QE all aboard the night train. Okay. Aussie dollar. Interest rates cutting supposedly, and QE not in play yet. So arguably They're actually pre this cycle. Although the Aussie is a little bit different to me because I don't think we're going to do unconventional things that way. Anyway, and then the yen, interest rates through the floor and printing money hard. So, according to this, really, what do we want to be trading? Probably not these guys. Euro yen's going to be a little messy fundamentally. On a day-to-day basis, why not? Sure, no problems. Probably want to be looking over here, and obviously euro dollar, and we've been concentrating on those things effectively. Now, the stock market is interesting. Oh, the other thing I wanted to talk about while it's on the top of my head is we've been getting little bits, I don't know if you've noticed, little bits of better European data. And when I say better, it's the patient is missing 2 legs, an arm, an ear, and, somebody's poked their eyes out as well. And now all of a sudden, they've replaced their eyes, but they're still missing an arm, a leg, and an elbow, and an ear. So, yes, there's better data, like CPI came out year over year, I think, 0.5 or 0.6 versus 0.5 or something, and they called it, the recovery is happening. I mean, we're talking about very subtle, very, very subtle, almost allowing, it's almost so subtle it's a rounding error. But then we saw slightly better French news, and we saw slightly better German employment data today. It's just these subtle little upticks in the European data. Is it enough to change opinion? Absolutely not. But it's just interesting to me that there's a little bit of an uptick. And it's something to keep an eye on, certainly. Is it a consequence of Draghi printing money? No. There hasn't been enough time for any of that to really spill through to the economy. But the US saw a nice recovery. The euro has been very weak for very long. It's possible that they're just organically seeing a little bit of a recovery because of the knock-on effect of this, this stuff. Okay. The other thing to think about as well is, guys, staunch dollar strength is as good as, if not better than, a rate hike. It makes American goods very expensive. Try coming to the US on a holiday. One, the guy at passport control is the most unwelcoming human ever to grace the face of the earth. And 2, your euro/pound/Australian dollar goes nowhere. /South African rand. Very expensive on a tourist basis, very expensive to import American goods right now. And that is as good as a rate hike, isn't it? That's something to think about. And that makes me think that the Fed is going to maybe hike rates, 25 basis points more just to not disappoint people. But expecting, 6% by the end of 2016, dreaming. There is zero wage inflation in this country. Although we're producing a whole bunch of jobs, the jobs are all at McDonald's, Walmart, and Target. And tons of seasonal spikes for the non-stop political cycle in this country, and the Halloween, let's employ a bunch of kids to work selling puppets and pumpkins. Costumes and pumpkins. And as a result, you get this big spike up in employment, all earning $8 an hour. So things to contribute to the steepness of potential Fed rate hikes or lack thereof. The interest rate, we look at sort of something like this. I think they're going to get way behind the inflation curve and have to do something like that, but in a couple of years' time, not anytime soon. Right, so what does all this mean? That the market is selling euro on decent European news. They are expecting rate hikes in the US, cutting rates in Australia, although delusional. Europeans are printing money. The US is still buying bad news. Have you noticed that? I'm talking about the stock market. So what are some signs of a trend change? Remember that if you are in a uptrend, okay, the strongest sign of an uptrend is when you buy good or bad news. Doesn't make a difference. Good, the news is great, awesome, let's go up. The news is terrible, great, let's buy. Okay, this is the strongest sign of an uptrend. Okay, what's sort of the next sign is when they buy on good news and kind of they're indifferent to bad news. It doesn't really go anywhere. It just sort of flattens out on bad news. Okay, this is the next sort of level of strength of a trend. And this applies to bearish trends too. All right, and what's the next sort of level where they buy good news and sell bad news? So this is sort of level, this is prime time level 1, 2, 3. And what's the sign that the trend is kind of starting to come to an end? And reverse is when they start to sell good news and sell bad news. And the kicker to this is extreme volatility. Like, massive spikes both ways, people getting chewed up on both sides of the spectrum. All right? This is level number 4. We are probably trying to roll over. And it recovers. What happens is they sell it initially, and then it sort of recovers half-heartedly until the next news event. And it becomes extremely news sensitive and extremely volatile. And it's that point of like when you're in a relationship and you're just fighting all the time and it's extreme volatility. It's time to break up. This is the same thing. This number 1 period is when they can do no wrong and everybody's happy on both sides. Okay, and then the reverse obviously applies to downtrends. So my question is, where are we here on the stock market side of things? Lately we've kind of been somewhere like here. I want to say some weeks we in phase 1 where they're just buying everything, which is Monday and sort of Friday of last week. And I'm seeing a little bit more of this going on now. But less follow through on the buying. Can these sort of go to 2 and then they, put their foot on the gas back to 1? Yes. But remember our little interest rate quandary. And the thing is too is that people are worried about people are worried about interest rate hikes to crush the stock market, but really, we're forgetting about bullish years where interest rates were at 6, 7, 8%. So it's not about that though. It's about cutting off the crack addict from the crack, which is free money. Okay, so I see this kind of transitioning more towards phase 3 as we move forward, just as, people look for reasons or, to trade both ways, or rather they look for information. Reason is a bad word because we know the market tends or can move on an unreasonable, beggars belief logic sometimes. But I think that we are kind of sitting in a transitional 2 to 3 sort of area, where good news is going to be rewarded, bad news is going to be rewarded on almost a day-to-day basis. So in other words, this sort of supports S&P range, if nothing else. Okay? As far as the dollar goes, we are this week trading on number 1. Good news, buy dollars. Bad news, buy dollars. So the question is then, is this sustainable? And we'll look at a chart to try to figure that out. And it's kind of on a currency by currency basis relative to the dollar. And that little sort of cycle I showed you of the way things work, you can almost see it in practice today. What's the strongest? The pound. What's the second strongest? These guys. Third, these guys. The fourth, Aussie. You can see that little flow just in the microcosm of today. It's a convenient day to see that model. So the lesson is really, when you're doing your fundamental analysis, try to figure out where you are in the anticipation of these cycles. Then take into context that they take a very, 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 very long time to shake out. And then think about what are we doing in terms of the interpretation of data points on a sustainable basis on our scale of bullish to sort of bearish here. Does this make sense? I know this is a fairly dry sort of webinar so far. So let's get to our sort of hard technicals here. So you guys know that I'm long through here, through here, through here. So I'm a little squeamish right now. These are uncomfortable times. Yeah. Because these guys are, although the position is sort of averaged down, this is uncomfortable times here. Because what happens if you guys are right and this goes, how's your uncle? Then I'm going, sad face. Okay. So let's look at a few things. Why there's a small method to this madness, this preposterousness. Right. One is, look at a euro dollar. What is this thing? Weekly chart. Little trend line here that is holding for now. A little bit of tear that is holding for now. And if I zoom out further, you can see that this was a very important level. Okay, now the other thing I wanted to point out is this, and please don't get me wrong, I'm not making a case for the euro being sustainably bullish against the dollar right now. I'm not doing that. I I mean, I just showed you that phase of 1, 2, 3, 4 in terms of data interpretation and relative strength of trends. And we are teetering between 1 and 2, the strongest mojo, right? So I would be way off point to to suggest that the euro is a magnificently bullish entity at the moment. That's not the case. All right. However, I think on a short term, the dollar will lose some strength. The other thing to think about too is that seasonably, April is the weakest historical month for the dollar. The most bullish month is May. So the weakest is April. The most neutral month is March and September. So we're coming out of those. But the most bearish month is April. Most bullish is May. And then we're kind of indifferent for the summer, which is typical. And the most volatile is September, which is when the money comes back. We know this just by looking at the chart. So, point being here is that if I show you a monthly here as well, this is the 21 EMA. Take a look historically as to the distance where this was before it made some semblance of a recovery. I'm actually going to use the chart trend line here because I want to illustrate a point. Okay, remember these things lag. But if we measure this distance and then take that measurement and look where it was elsewhere, can you see that we are essentially at that threshold? And you can see that this repeats itself. I hope you can see me dragging it around the screen here. Can you see that this is, it doesn't mean a change of trend, but can you see that this distance relative to the moving average is consistent? It repeats. And it doesn't, like I said, it doesn't mean that there's going to be a change of trend, but a small correction, yes. And look where we are here. This is the most extended it's been. This is the 21 moving average, 21 EMA. You see that it's at that threshold right now. So am I expecting a reversal? No. But I am expecting sort of something that maybe pushes down here initially at the new month, even makes a lower low hypothetically, and then actually finishes the month with a candle that looks like this. Oops, that's not what I wanted. Something that looks like that. And then next month it starts by pushing up, and we see something that takes us almost all the way down here. Okay, so my trade plan with this logic in mind is anything from 105 to 107, and yes, it could go lower, with a target of even as high as, I think it could get even as high as 114, but anything around 1250, anything around sort of 1250 to 13, happy. Because at that point, I'm looking for shorts between, the 14s and 16 range for a 700-800 point pip drop. So this is my buy side for April. And then the sell side would be something that looks like 1.14/16 down to 107 again. Basically taking it right back to where it came from. Just because you know how these things, they tend to stretch out before they come back. And if I show you, let me pull it up here real quick. And I obviously don't use seasonably adjusted things a lot, but I think it's applicable just because we have a new month. And if anything, we tend to see spikes on these ranges too. So I think that we could almost see sort of something like this develop if we want to talk about my plan initially on this was something that looks like this. By the way, I consider, even though this is turned down on the daily stochastic, next time we should probably do a whole lesson on stochastics and oscillators in general. I'm a price action guy, but I definitely lean on them a little bit for different things. This, in my opinion here, is actually a bullish stochastic. I don't consider this turned down bearish. Because what typically happens is it'll cycle up, look bearish, and then you'll get one of these. I mean, that's it's just how they work for whatever reason. So that makes me consider do something like this. Yeah? Oh, okay. Something to think about. So my plan even on the short term for the next week was something that looks like this. Then a sort of a bottom out. It's going to look like a lower low double bottom and then kind of tick up here. Right? So I'm long through this puppy, looking for this, and I'll step aside while the short happens and then try and long it again to the 104, 103, looking for 1,000 pips, roughly 800. And it's bizarre. It doesn't look right. I mean, I'm sure a lot of you are going, Pegler, a euro long? That's preposterous. What? I mean, in theory it is. I think the reality might be something different. The same, and I'm giving you, and here's the danger, okay? Here's the danger of listening to a webinar like this, is that as an analyst, I obviously am making a case for myself, right? And depending on how good a salesman I am to myself, I'm going to shove that down your throat too. So while I appreciate you listening, go away and forget everything I said and think about it for yourself. Weigh up the pros and cons. Even make a pros and cons list for yourself. All right? But that is the danger, is that I don't care if this, I'm okay with this if it goes, I'm fine. Yeah, these positions are going to make me squirm, but I'm still okay with it. Where somebody else's risk tolerance and how they do things might be totally different. So you've got to account for that as well, is that my opinion has my way of trading built into it. good morning, or good afternoon. Okay? So that has to be a full disclosure there as well, is that you've got to factor that in. But, there's a few reasons why I've given you this. The other thing to think about is the dollar index, which is basically the receptacle of the euro. Here this is. Note the number it's coming off of 100. All right, and if I show you this monthly chart, and the monthly charts are applicable because it's the change of a new month. Thanks very much. I appreciate that. We've run up into this sort of spot here. I thought that we'd have a tough time breaking through 96.5. It went through there like a hot knife through butter. But what it's done also here is it's given us some reference points. So there's a few things of notable sort of coming off 100, the figure, that's no joke. Look at the distance to this 20. I mean, it is extraordinary. Effectively, we saw the same kind of thing on the downside here. Relative to how far we were away from it. And this isn't a hard and fast rule as to why you should change direction and go the other way. It's just something, it's a piece of information that's definitely, noteworthy. Look at this thing. You want to talk about the elastic band being stretched. That, boys and girls, is stretched. It's always difficult to try and I don't like trying to persuade people to go against the trend. If nothing else, you can say, a different way to use this information is to go, okay, I appreciate what you're saying, David, but I'm going to wait for the buyer down here. I'll just switch to a weekly. If you said, point taken, and if I miss a move that goes from 108 to 103, I'm okay with that. But maybe I'll just wait to short it in the 112 to 114 handle looking for 1,000 pips. And then you know that you're with the trend and there's a ton of resistance and you've built a case based on a bunch of things and you've got all this stuff to go on and the fundamentals in your favor, the technicals in your favor, and if that's on your mind, that's brilliant. That's patience. I like it. You're going to make a lot of money over a long period of time. I just sort of see something like this happening. And then we'll have to work it out because I think sort of early 100s will be a top for a long time. But this is kind of what I'm expecting, so I'm chasing this for now. Okay, right. Now let's talk about, and the pound is going to be slightly different, and the Aussie is slightly different. Over the long term, I am more Aussie and Kiwi bullish than the euro and the pound put together. The Australians are doing a lot of good things down there. They have that country together. They're not fighting with Greece over miscellaneous things. They have their country together. Yes, China's only growing at 6.5% relative to the 10 they were growing at. But that's actually healthier. It's actually better. It's more sustainable. So once they've absorbed that, Australia's going to be the currency to be in. Buying it in the 70s for 90 cents to parity, it's going to look genius in the next few years, I believe. 70 cents on the Aussie relative to where it was. You're buying it at almost a 40% discount. All right, how are we doing on time? We got 5 minutes. Let's talk about the S&Ps. Yeah, just look at it. We're going to do 1 minute there. Had a 75.80 order on that and missed it. Big, fat trend line here. Lots of junk here. I could see us doing something like this. I'm Aussie. I'm sorry, Jen. You're absolutely right. I'm a buyer anyway in the mid 46s. Like 46.50, 46.80, like you were saying. Trying to take that thing back to about 150.50. It's tough to do anything with it in this range. Sell it or buy it, in my opinion. See, we kind of there's a few things. It's the fundamentals that we talked about for the first half of the webinar. It's technical price action, as far as sort of how to define trends, etc. I do, but it's hard for me to. Okay, let me address one question. I'll come right back to you, okay, Jen. I did promise you. I'm sorry, I'm not neglecting you there. I'm trying to answer three things at once. Let me finish with the Aussie. I'll knock out your cable question and we'll come back to that bias and we'll hit the S&P all in 5 minutes. The other thing to think about too with the Aussie is this guy here. This is gold. Check this out. I can see one more leg, boom, and it recovers, something like that. And then sits there. But this will lift the Aussie through here. Make no mistake, Something to think about as far as lining that thing up. Because we always talk about trades. The Aussie long in the 70 cents, sort of early 70s, in my opinion, is a sort of an investment grade trade, something you could conceivably have for a long period. A long period, like a long, long period. Not going to hurt you on swap either. Okay, pound. Two minutes. Pound is at the bottom of this very long-term range. It hasn't really been able to breach this range in some time. But this stochastics is still hard down. Though massively oversold, it's still hard down. But it is support. So I would see, I could conceivably see kind of something like this develop. A higher low relative to this previous, but a lower low relative to this one. And then it sort of grinds its way up here before challenging that spot again. And I'm sure most of you are looking at this going, well, that's great, David. These are just squiggly lines that don't really mean anything to me. This is, this sort of bottoming out behavior is just something that we've seen, more of an experience-based thing. Because this is the sell point relative to this drop. And then this is the buy point relative to that previous support. So you're going to see a little bit of a fight there. Given the dollar bias, I would expect this to sort of go up and a little bit of sympathy with that, while the euro pound tries to make a double bottom at 70 and change. Makes sense? Which will give this pound a little bit of relative strength. So that's how I see it. And then this would be your 4680, 4700 and change trade. I've got a few buys in here, but I'm really waiting for another little jog. It's not, pound's tough right now because I think we fundamentally in sort of a transitional little period. GDP came out decent today, but that's just one piece of information to the pie. How are we doing on time? We're there, aren't we? Let me just show you the S&P and we'll wrap this puppy up. Take me 1 minute. This is what it boils down to on this one. Remember our largely neutral, sorry, this chart's going to get clouded. Our largely neutral stance here, I could actually see something like this happen. It fails here, tries to drop down to the 50 area. No, actually spikes up, shakes a lot of people out, and then thanks. 20% sort of, and then it's neutral for a long time as the Fed figure it out. And then this here is a fake break of that high. You know what I mean? Makes sense. I'm feeling that. So the daily would look kind of something like this. I don't have all the reasoning for you because we're just out of time, but we can tackle it next time. It's not going anywhere. Kind of something like this. No. Oh, it's bullish again. No, it's not. It's not. Okay. So, thank you for attending this session. I hope that you at least got something out of it. Those of you that came in late, please check out the recording later on today. And if you have any questions, Twitter me at ForexDavid or email, whatever. All right, guys, and we'll catch up with you later. Take it easy.